morning, I'm James Gruber. Welcome to the morning report for Monday the 16th of March. Well, ongoing uncertainty around the length of the conflict in the Middle East and subsequent disruptions to supplies through a key maritime route will remain on the minds of investors this week, but it's also a big week for major central banks. 8 will hand down policy decisions over the next few days. The RBA will be the first, with its interest rate decision tomorrow. The RBA begins its two-day meeting today, and there's plenty of talk about oil prices. They've risen from the mid-60s before the conflict to now above $100 a barrel, and how that has fed through to inflation. Let's get into what's on the cards when our share market opens later this morning, and commodities as well as currencies. So the futures are pointing to a drop at the open for the ASX 200 of 0.7%. which isn't a huge surprise given the drop in overseas markets and risk-off sentiment. Our share market ended the week down 0.14% to 8,617.1. Over the 5 days to Friday, the index has lost 2.64%. During the session on Friday, losses in miners outweighed gains in financials. The Middle East conflict stoked inflation concerns and lifted expectations of a rate hike. Gold producer Northern Star Resources slumped 19% after warning it may struggle to meet the lower end of its fiscal 2026 production guidance. Virgin Australia and Qantas have both fallen a little over 13% in March so far, as jet fuel prices surged after the conflict began. Technology, gold and healthcare stocks fell between 5 and 10% during the week. And on the gains for financials, they were up 1% in the session, but ended the week down 0.4%. All 4 major banks rose between 0.5% and 1.5%. Moving to commodities, oil prices rose on Friday as Iran tightened its grip over the Strait of Hormuz. And there were reports that the conflict had spread to Lebanon, Kuwait, Iraq, the United Arab Emirates, Bahrain, and Oman, which dimmed hopes of a near-term resolution. Brent crude prices finished 2.7% higher to $103.14 a barrel. Gold futures dipped on Friday on US dollar strength and inflation worries. The futures settled down 3.4% to $5,062 an ounce. Base metal prices also fell on Friday on a stronger US dollar as well. Copper futures were 1.8% lower, while aluminium futures tumbled 2.3% after previously reaching near 4-year highs. Iron ore futures rallied though for a third straight session, as expanded restrictions on cargoes from BHP sparked concerns over supply that were compounded by expectations of rising hot metal output in China. Futures ended up 2.2% at $105.14 a tonne. Let's look at currencies. The Aussie dollar was last trading down 1.2% to 69.88 cents on US dollar strength as mentioned, and that spread across most currencies. Let's go back a step to see how Wall Street and other world markets did. On Friday, the Dow Jones index finished down 0.3%, the S&P 500 index was 0.6% lower, and the Nasdaq index fell 0.9%. There are some developments worth highlighting. The US markets ended down on Friday as investors gauged how the war in Iran was affecting the global oil supply. All 3 major US indices logged daily and weekly declines. Among the 11 major sectors of the S&P 500, technology shares posted the biggest percentage loss. Meanwhile, utilities enjoyed the largest percentage gain. Amid mounting concerns over credit quality, the S&P 500 financial sector fell 3.4% on the week. Design software maker Adobe dropped 7.6% after it was announced that its longtime CEO will leave his role once a successor is appointed, renewing worries over potential AI disruption. Meta Platforms slid 3.8% following a report that the social media behemoth has postponed the release of its artificial intelligence model Avocado to at least May. In US economic data, new figures show GDP expanded at an annualised rate of 0.7% in the December quarter, sharply down from the 1.4% rate initially reported, and a much slower pace than the 4.4% in the third quarter. The government shutdown was a big factor in the downward revision. Meanwhile, consumer spending rose 0.4% in January, slightly more than expected. And the Personal Consumption Expenditures Index increased 0.3% in January, in line with forecasts. US government bond yields were mixed on Friday after data showed the Federal Reserve's preferred inflation measure was in line with economists' expectations in January. The US 10-year Treasury yield was up 1 point to 4.28%, while the 2-year Treasury yield dipped 4 points to 3.73%. To the European markets, the continent-wide FTSE Euro First 300 index finished 0.5% lower, while the UK FTSE 100 also fell 0.4%. Europe extended its declines on Friday and marked its second consecutive weekly loss, as the escalating conflict in the Middle East and inflation worries dented risk appetite. Industrial stocks were the biggest drags, down 1.8%, while Siemens Energy was down 5.7% and Rolls-Royce was off 5.3%. Miners experienced the biggest percentage loss, down 3.3%, as prices of silver and copper tumbled. So what are we watching out for this week? Well, besides monitoring developments out of the Middle East, in Australia it's a big week of economic news, with the RBA scheduled to hand down its interest rate decision tomorrow. CBA economists expect the RBA to lift the cash rate by 25 basis points from 3.85% to 4.10%. They say inflation will lift further away from the RBA's target band of 2 to 3%, thanks to the Middle East conflict. And recent commentary from the RBA has confirmed its hawkish stance and focus on inflation. That's why it thinks the bank will hike rates tomorrow. In the US, the Federal Reserve will make its own interest rate call on Wednesday. Consensus suggests it will hold the Fed funds rate target range at 3.5 to 3.75%. There are also a host of other central banks making interest rate decisions this week, including in Europe, China, Switzerland, Canada, and England. That's it for today. For further developments on the local trading session, please tune in to the CommSec Market Update podcast this afternoon, and of course, the Market Close video. Have a great day.